All right, let's get right into it. You've probably heard the chatter online, right? Go buy a big, heavy SUV or a truck for your business, and you can write the whole thing off on your taxes. It sounds incredible, almost too good to be true. And honestly, it's a topic that creates a ton of excitement and a ton of really bad advice.
So that brings us to the big question. Can you actually do it? Can you legally use a heavy vehicle to just slash or maybe even wipe out your tax bill? Well, the answer, it's complicated. It's a yes, but it's also a very, very risky no.
And this really shows you the two sides of the coin here. On one hand, yes, it's an incredibly powerful and totally legitimate strategy for business owners. You can accelerate your deductions and really lower your tax bill. But, and this is a big but, it is also a huge red flag for tax authorities, mostly because it's so misunderstood and, frankly, so often abused. If you get this wrong, a brilliant tax move can turn into an absolute audit nightmare. So in this explainer, we're going to break it all down step by step. We'll start with the powerful tax rules that actually make this possible. Then we'll cover the single most important rule you have to follow. After that, we'll look at the common mistakes that get people audited. And finally, how to do it right from the start. Okay, first things first. To really get how this strategy works, we've got to look under the hood at the tax code itself. There are two key pieces that have to work together to make this massive first-year deduction a reality. First up is something called the Section 179 deduction. Now, this rule lets a business expense the cost of equipment right away, instead of depreciating it over many years. For the specific vehicles we're talking about, those heavy SUVs between 6 and 14,000 pounds, that deduction is capped at $31,385. The second piece of this puzzle is bonus depreciation. This is another tax incentive that lets you deduct a huge chunk of an asset's cost immediately. For 2025, that rate is set at 40%. But, and this is super important, you have to know this is a moving target. These percentages change based on what Congress decides. Not too long ago, it was at 100%. So how do you get that massive write-off? You stack them. Let's imagine you buy a $40,000 vehicle. First, you take that Section 179 deduction, lopping off that first $31,385. Then you apply bonus depreciation to what's left. You can see how, a few years back when bonus was at 100%, this combo let you write off the entire purchase price in year one. It's a really powerful one-two punch. But listen, none of that cool tax math matters without this next part. This right here is the absolute heart of the matter. It's the one rule that decides whether your deduction is legit or just an audit waiting to happen. So here it is, the critical point. To qualify for these amazing accelerated deductions, Section 179, bonus depreciation, all of it, the vehicle must be used for business more than 50% of the time. Not 49%, not 50% on the dot. It has to be more than 50. This is a hard and fast line in the sand. And this chart makes it perfectly clear. If your mileage log shows 70% business use, you're good, you're compliant, you can use those deductions. But if it shows 40%, you're out. You can't use Section 179 or bonus depreciation at all. You'd have to go back to depreciating the business part of the vehicle over several years, which totally defeats the purpose of this whole strategy. And here's another critical detail that so many people miss. Just because you clear that 50% hurdle doesn't mean you get to write off 100% of the vehicle's cost. Nope. The deduction has to be prorated. So let's say your business use is 60% on a $30,000 vehicle. Your maximum deduction is 60% of that cost, which is 18 grand. Claiming the full 30,000, that's a major, major error. Okay, so this brings us to how this whole thing can go so wrong. It's usually the simple mistakes and misunderstandings that turn a smart tax plan into a huge liability. And these are the exact red flags that auditors are trained to look for. Let's run through the greatest hits of audit triggers, shall we? First, trying to write off the family car that's never, ever used for business. That's a non-starter. Second, claiming 100% business use when it's obvious you're also using it to pick up groceries. The third one's a bit technical, but it's a huge mistake, confusing curb weight with GVWR. And the last two? They're all about proof. Having no detailed mileage log and keeping messy or even altered records.
So what in the world is this GVWR thing? Well, it's not how much the car weighs sitting empty in your driveway. That's called the curb weight. The gross vehicle weight rating is the maximum safe operating weight of that vehicle, completely loaded up with passengers, cargo, fuel, everything. You can almost always find it on a sticker right inside the driver's side door. That's the number that has to be over 6,000 pounds, and it's a sneaky detail that trips a lot of people up.
And really, this is the bottom line. According to tax experts, most of these deductions don't get tossed out because of outright fraud. They get disallowed because of a simple failure to provide proof. In the eyes of an auditor, if you don't have a clean, credible record to back up your claim, that business trip you took, it just never happened. Okay, so enough with the scary stuff. How do you do it right? How can you use this powerful deduction and build a rock-solid defense just in case you're ever questioned? Well, it all comes down to being precise and super diligent, right from day one. Here is your blueprint for success. Step 1, before you even think about buying the vehicle, verify its GVWR. Step 2 is totally non-negotiable. You have to keep a detailed, contemporaneous mileage log. And contemporaneous just means you record your trips as they happen, not trying to remember them 6 months later. Step 3, keep every single receipt. And finally, step 4, be ruthless about classifying every single trip as either business or personal. This right here, this is what good documentation actually looks like. It is not just a list of miles. It's got the date, the destination, and, most importantly, the specific business purpose for that trip. See how it also clearly separates out the personal trips, like that run to the grocery store? This is the level of detail that makes your records defensible. And believe me, these are not just theoretical risks. In a real 2023 tax court case, a business consultant had their entire vehicle deduction thrown out. And why? The court found their mileage log was just a mess. It was full of inconsistencies, conflicting odometer readings, and even receipts that look like they've been altered. It's a powerful reminder that your proof has to be credible. So, as we wrap this up, let's just boil this all down to the one central idea you need to walk away with. It's really about a fundamental shift in how you think about this. Look, this tax strategy is not some secret loophole to get a free truck. It's a specific tool created by the tax code to encourage businesses to invest. And just like any powerful tool, you've got to treat it with respect and precision. Success here isn't about trying to bend the rules. It's about following them meticulously and documenting every single step you take. So from now on, instead of asking yourself, what can I deduct? I want you to start asking, what can I confidently and credibly defend with proof? Because when you build your records with that question in mind, you're not just taking a deduction, you're making a defensible business decision.